While everyone was glued to the fireworks from Bitcoin ETFs this year, a more significant story of 2025 was happening in the shadows, completely off the mainstream radar. The world's central banks have been quietly continuing a massive strategic shift, and it has nothing to do with crypto. They're hoarding physical gold, extending a multi-year trend with serious force. What this signals about the future of money is something the markets are overlooking. They're quietly building lifeboats while the Titanic of fiat currency steams toward an iceberg. Today, we're going to give you a framework for what the data suggests is really happening. Let's be honest. 2025 was supposed to be the year of Bitcoin's big institutional debut. And on the surface, the numbers looked incredible. The launch of spot Bitcoin ETFs was hailed as a landmark moment, a bridge finally connecting the Wild West of crypto to the polished halls of traditional finance. Throughout the year, these ETFs attracted tens of billions of dollars in net inflows. BlackRock's IBIT was a runaway success, and headlines celebrated that a huge chunk of Bitcoin's supply was now held in these regulated funds. The story was simple and seductive. Institutional money was here, and it was sending Bitcoin on a one-way trip to the moon. This was the official story. It was plastered all over the financial news and dominated your social media feed, convincing many investors that crypto was the primary game in town. It was an understandable focus, a shiny, new object that captured the market's attention. But while everyone was watching the money pour into Bitcoin ETFs, they missed a bigger, more important flow of capital happening behind the scenes. Now, let's pull back the curtain and see what the smartest money in the room was actually doing. I'm not talking about hedge funds or retail traders, but the central banks, the very institutions that run the global monetary system. My goal isn't to predict a price, but to give you a dashboard of what to watch. Our dashboard focuses on a few key metrics: real yields, global liquidity conditions, inventory levels at the COMEX and LBMA, and gold lease rates. And right now, that dashboard tells a different story. For several years running, global central banks have been buying physical gold at a historic pace, marking the strongest, most sustained demand since the gold standard era. The pace in 2025 did moderate from the record-shattering levels of 2022 and 2023, but reported purchases remain significantly above historical norms. This doesn't look like a flash in the pan. It looks like a structural, multi-year strategic shift. But here's the key indicator on our dashboard. In 2025, there are credible reports that gold is becoming a bigger share of reserves relative to treasuries. Let me say that again. Some nations are, in aggregate, starting to allocate more value to a 5,000-year-old metal than to the debt of the world's leading superpower. This suggests a significant reevaluation of reserve asset strategy. So what's driving this shift? It isn't just one thing, but a convergence of powerful forces. First, there's the quiet but persistent trend of de-dollarization. For decades, the US dollar has been the undisputed king of global finance. But the weaponization of the dollar through sanctions has pushed other countries to look for alternatives. They need neutral reserve assets, assets that can't be easily frozen, seized, or devalued. Gold is the ultimate neutral asset. It has no counterparty risk and no single government controlling it. Second is the trap of negative real yields, a key metric on our dashboard. In 2025, even with elevated rates from the Fed, persistent inflation meant the real return on holding cash and bonds was often negative. That old argument against gold that it has no yield loses its power. Why hold a government bond that might guarantee a loss in purchasing power? In this environment, gold's zero yield is a relative strength, not a weakness. And third, gold is reaffirming its role as a primary insurance policy. In a year filled with geopolitical tension, shocking tariff announcements, and deep uncertainty, gold performed as it has historically. It acted as a hedge against chaos. It's not just a hedge against inflation. It's a hedge against policy mistakes, political instability, and the perceived risk of the system itself cracking. If you like analysis that focuses on signals instead of headlines, hit subscribe. In the next video, I'll show you the framework I use to understand why gold and silver are surging at the same time, and why they're doing it for two totally different reasons. That framework makes the rest of this series click. This brings us to the great comparison of 2025, which gives us a sequencing concept for what happens first and what happens next. This isn't a story of Bitcoin versus gold, but a tale of two different asset functions, the reserve regime versus the liquidity regime. Gold had a remarkably strong year. It surged to hit all-time highs. This wasn't a speculative meme coin rally. It was a deep, structural move driven by the world's largest and most conservative institutions securing their futures. Gold was one of the best performing major assets of 2025. Meanwhile, Bitcoin's path was choppier and more liquidity sensitive. Instead of acting like a reserve asset, it behaved more like a high-risk tech stock. The ETF adoption, ironically, contributed to this. It brought in institutional money, but that money treated Bitcoin just like any other risk asset. When macro fear spiked, institutions sold their liquid risk assets, and Bitcoin was high on the list. Its correlation to the Nasdaq even increased in 2025. This isn't a failure of Bitcoin, but a clarification of its role. This gives us our repeatable sequence. Gold is the confidence hedge. Bitcoin is the liquidity play. And here's the key bridge. If gold is the confidence hedge, the next question is, what happens when that confidence hedge pulls the rest of hard assets with it? Because that's where silver enters the story. The market tells you which regime you're in. So what's the takeaway for you? The lesson of 2025 isn't that Bitcoin is bad and gold is good. It's that you have to watch the plumbing, not the headlines. The lesson is that different assets serve different purposes, and it pays to watch what the most powerful players are doing, not just what they're saying. Remember the sequence. Gold is the confidence hedge. Bitcoin is the liquidity play. Gold is functioning as a reserve hedge, pricing in geopolitical risk and potential policy mistakes. Bitcoin is functioning as a liquidity asset, thriving in risk-on environments when global liquidity is expanding. For your own strategy, this means understanding the role each asset plays. Gold, in 2025, did exactly what it has done for millennia. It acted as a store of value and a hedge against systemic uncertainty. Bitcoin has shown itself to be a liquidity-sensitive risk asset. It has a bright future, but it has not yet played the role of a safe haven. The signal being overlooked is that the foundations of our financial system are undergoing a gradual transformation. To wrap it up, the story of 2025 wasn't just the noisy, headline-grabbing launch of Bitcoin ETFs. The key underlying story was the quiet, relentless accumulation of gold by central banks. A signal that the architects of the financial system are preparing for a wider range of future outcomes. There's a saying that captures this perfectly. Bitcoin didn't fail, the expectation failed. The expectation that it would act as a reserve hedge during a time of real-world stress was in this instance misplaced. Instead, it performed exactly like the volatile, liquidity-driven risk asset it is. Meanwhile, gold quietly stepped up and did its job. In a world facing high debt and massive uncertainty, the quiet hoarding of a 5,000-year-old asset is the most important signal on your dashboard. The only question is, are you watching? Now here's the setup for what comes next. Gold moving like this is the confidence signal. But the market is also telling us something else, that silver isn't just tagging along. In the next video, we'll break down what I call the great specialization. Why gold is being treated like a reserve asset, and why silver is being repriced like a strategic industrial metal that also happens to be money. Drop a comment. Are you watching this more as a confidence issue, or are you betting on a liquidity expansion next?